Okay, great.
Hello, everyone. This is episode 9 of Investment for Beginners. With me today, as always, is Michael Wiggins, the Oliveira from Deep Value Returns on Seeking Alpha. How are you, Michael?
Hey, I'm very good, Manuel. I'm very excited to be here. So we're in the middle, in the middle of the earnings season, and I think it's quite exciting because it's a really charged period right now. If you anything to do with investing right now, this is like it's like everything is like culminating at this moment in time. So, Manuel? Can you tell us what we're going to talk about today?
Yeah, we've got. Well, I wanted to listen to your inputs because we've last week we've had the FANG post results. Almost all of them had great results. But then on WhatsApp, you told me that you wanted to talk about what you're seeing, and you threw out Peloton out there. So I'm deeply curious about what you have to say, what you're seeing, and Peloton in particular. So let's do it.
So this is something that I'm very excited about because for a very large period of time, let's say like 12 months or so, everyone has been caught up with this theme. The theme was, as long as the business is growing and you're paying, let's say, a reasonable price to sales multiple, everyone was quite willing to pay large valuations, assuming that the business had some subscription element to it. Okay.
And nice point.
What happened with Peloton specifically, but you can look at other businesses too and extrapolate this insight also. So in the case of Peloton, they said, okay, we've had some kind of supply chain issues. But I don't think really the problem is so much the supply chain issues as it is that just demand naturally kind of faded away. People went around and did other things, easing of restrictions, and the demand for their bicycles kind of came down. They tried to put the price down to bring in a large number of a large audience, but ultimately this, was they put the price down, not down enough to bring people on board. And if you remember the hardware side of Peloton, the margins are very, very thin there. They're not supposed to make that much on the bikes. What you're supposed to make is on the subscription. But if people aren't buying new bikes, then obviously people are not going to be as aggressively taking their subscriptions. Now, one of the things to remind ourselves is that Peloton is able to sell those subscription to people that haven't got their bikes. So you don't need to have their bike to get their subscription. If you want someone kind of shouting in your ear, do 100 press-ups off the bicycle or whatever, you can just pay them. You don't have to kind of get their bike too. But what you've seen is this kind of thing that people are paying, let's say, for example, 2 or 3 times the sales multiple, but they're not thinking that much about, okay, out of that revenue, let's say 80%, for example, hasn't got that much value because they're selling it at cost. So you're only paying for the 3 times multiple that you're paying is actually the only bit that's attractive is the, let's say, the 20 to 25% of the underlying subscription business. And you can say the same thing for, let's say, other businesses like Roku. So Roku's business model is that they sell you these TVs that has this operating system. You don't even need to sell, but sell you some hardware, let's say, because you can just plug it into your TV. But they sell you some hardware, and that hardware is not supposed to make any margin for them, but you're supposed to just get into their system. And once you're part of their system, they sell you ads. And the business model from the ads is very, very attractive. Now, the problem is that people are paying, let's say, 14, 15 times forward sales for Roku as a whole, but only a portion of that was exciting. The rest of the business is like, okay, yeah, I mean, the margin business is not that attractive. So what you're left with is these type of businesses that everyone saw as the new businesses, let's say these kind of Pelotons or Rokus. And ultimately what surprised me quite a lot was that when I see some of these, the old FANG names, let's say your Facebooks, now called Meta, like you see this kind of the old businesses. For example, Facebook was up 34% year over year. this is just mind-blowing. They're huge. Facebook is absolutely huge, and to still be growing so fast.
Don't forget where you were going with that. Facebook went up, the revenue went up 35%, Alphabet 41%, Amazon 15%, it was the laggard, Apple 29%, Netflix 16%. So great results overall.
Yeah, but it's quite interesting that it's so the newer businesses that we are seeing, right? These kind of ones that came in and were, as it transpires, these businesses like Roku, like Peloton, are nothing but COVID winners. They had their COVID moment, and now it transpires that actually they haven't got the stamina to keep growing at that pace.
So in the case, include Zoom on that group?
I haven't followed Zoom's earnings right yet. I don't think that they've reported quite yet. I'm not really sure about that. But yeah, I don't not including Zoom. So Zoom, there's a question mark as to whether they can continue growing at that pace. I'm not quite sure. But what I do know is that it's just quite interesting that we thought that these businesses, we're paying just crazy valuations for them, but actually, as it transpires, they're not actually growing that much. And it's like, should I really be paying a higher multiple, for example, for Roku or for these type of businesses, when I can get Facebook at, let's say, 8 times forward sales? There's no question marks that Facebook can print money, right? Anyone that's ever invested can recognize that Facebook is literally just a printing machine. Like it's like this, it's unambiguous. So why should anyone be paying 15, 20 times forward sales for a business that, you know, it's difficult to know if they can continue growing for, let's say, the next 15 years. And just as one more kind of segue on this, about these kind of new businesses that are kind of very exciting and they're doing all the kind of things, is within the tech companies, for example, Cloudflare. Cloudflare is something that we talked about in the last week's episode. And you can see, okay, so Cloudflare is growing at 50%. Very strong numbers, okay? Yeah, wow, 50%, yeah, great things, right? But people are paying 72 times forward sales. So it's not 72 times for this year's sales, it's 72 times for next year's sales. And it's not about, we're not even talking about earnings here. It's not 72 times forward earnings. We're just talking about sales here. Yeah, and I know that at some point in the future, they may be making a lot of strong profits. But if you look at their financial model, they're saying to you, okay, we don't think that our business model can make more than 20% operating margins. So at what point do you say stop? I mean, like, I don't know. I don't know. Like, you look at these businesses and you can say, maybe they'll keep going 50% for a very long time. But like, are the odds in your favor? I mean, I don't know. I just find it very difficult. If investing is about two things, if investing is about not losing your capital, and if investing is about trying to figure out where the odds are in your favor, I can't see how paying such a high valuation leaves you any more upside potential. Because if your business is growing at 50%, okay, and the multiple is so high, at some point, the multiple starts coming back down and to follow intrinsic value. Because in a short period of time, let's say a year or two, everything is about the multiple. The multiple expands, the multiple compresses. But over a kind of a more steady period of time, at some point, it's gonna follow the growth of the business. And if the business struggles to keep growing at 50% for the next 5 years, the multiple doesn't compress slowly like we see with Peloton. You get it in one night, in the after hours market, your stock is down 35%. And you're like, oh, I should have sold. Yeah, that would have been a good decision. I mean, like, you can't pick the top, right? So you either sell slowly on the way up and you kind of feel like, oh, damn it, I should have held on, or you sell very quickly on the way down. So there's no kind of point to get out at the top. What kind of things are you seeing in some of the stocks that
you've mentioned? Peloton, the two segments, which is the sale of bikes, and now they have treadmills as well. But let's say bikes, and then the subscription business. And it reminds me a little bit of Facebook with this investment in the metaverse, in virtual reality and all of that. And they've actually been like subsidizing the VR headset, the Quest headset, or selling it at cost, because they have a bigger vision for it, the metaverse. And we can talk about that in a later episode. I'm not going to go deep into that today. But I was thinking, one day, with all this VR stuff coming along, you can have Peloton, or you can have like Facebook investing, Facebook or any other company, throwing out a Peloton type bike with much more success. And today you can buy Facebook at, I don't know, 25 times earnings. And
crazy.
It has as you said, it prints cash. It has what you could say will be, in theory, a much better business than Peloton, which is the VR set. Now everyone's, a lot of people are, how do you say, exercising with those apps inside the VR world with Oculus Quest. So you can buy Facebook much cheaper than Peloton with a similar, and I would argue that it's a much bigger addressable market. The one VR headset has a much bigger addressable market, but let's say that it's similar to the addressable market of Peloton, and you're buying it at 25 times earnings versus Peloton, which doesn't have any earnings.
And another thing that's quite interesting. So in the case of Peloton, the addressable market is a wealthy consumer. Those bikes are not cheap. It's interesting to make the comparison. Facebook and Peloton have nothing to do with each other, but ultimately there is some overlap. So in the case of Facebook, their business model is so powerful because you don't pay practically much to get it, right? So talk about Oculus, it's not that expensive, right? And it gives you other things. For example, they've often talked about their interest in making commerce within the metaverse. So the ability to transact, I could be in the metaverse with you transacting, and we could just hang it out. We just hang it out in your living room, because I think your living room looks a lot nicer than mine. They just be hanging out in your living room, and we like selling some stuff. Oh, do you want some kind of creative beats? I can sell you this, and we can kind of transact. You give me a digital coin. Everyone is happy, right? In the case of Peloton, it has this one dimension, and it's like everyone's saying, Peloton is going to be like the next Apple. We're thinking about that NPS, Net Promoter Score. The Net Promoter Score is something that's so important, and you can see that they have a Net Promoter Score of, I don't know, let's say 75, very high Net Promoter Score. It's like the next Apple. It's not the next Apple. It's able to do one thing, okay? And you only want to do it at certain times in the day. With Apple, it's like everywhere you go, right? It's in your pocket. It's an extension. It's like your third arm. Everything you want to do, like if you want to buy tickets to go to the cinema, it's like there. I pay for it. I show the little phone at the door. It's like it's not the same. It's like everyone says, they kind of get you in the case of Peloton, they're able to do more things off the bike, right? They say, okay, so we have a larger proportion of our users are now doing stuff off the bike. That could be running, that could just be doing like exercises away from the bike. And that's ultimately one product, right? It's just one idea. And it's not the same, and it's not an ecosystem. Everyone's saying, like people put these buzzwords, and it's like it blows my mind. I mean, to be fair, if it had happened that Peloton had rallied significantly, our podcast would be very different today. We'd be saying, the guys, they did amazing, and it's very easy in hindsight. I am not a fool. I know that it's just too easy in hindsight to build a narrative and to show what's right and wrong. But that's why I gave you the example at the start about Cloudflare, because I'm not giving any hindsight. The stock is like at all-time highs. In the last 90 days, it's jumped like 110, 115% in the last. So there's no hindsight bias. I'm saying right now that, this is just for educational purposes. This is for entertainment. It's not an investment advice, but it just makes me think. How, like, just about the odds, right? So I'm not kind of doing backside analysis on the stock of Cloudflare. I'm saying, okay, just think about that for a moment. How expensive is a company relative to what you're going to get out of it. And it's quite interesting because we're right now in the middle of this earnings season. And what I've seen in these kind of other businesses, for example, I don't know if you noticed, but advertising stocks as a whole, not in the case of Facebook, as a whole, they've meaningfully sold off. You see, Twitter's taken a hit. I've taken a hit of that. Snap's taken a hit. Magnite, which is an ad tech company, is taking a huge hit last week as well. And Roku, as I discussed already, has taken a hit. So it's quite interesting to see that these advertising companies, everyone thought, okay, so Q2 of this year was very strong because year over year for advertising stocks, it was against the COVID quarter. So it looked very, very strong. Q3, people's expectations got misaligned and people felt that Q2 was the new normal. And now Q3 comes out, growth rates are not as strong. The guidance for many of these companies for into Q4 is kind of like meh, kind of like middle of the road, so not attractive. And you're kind of like thinking, so what is the new normal? Is the new normal Q2 last quarter, or is the new normal how we're looking for these companies going into Q4? And everyone's kind of paying a really high price, and me too. You know, I was also kind of caught up in this. People paying a really high price for these kind of advertising companies because they're so lucrative. All these advertising companies, they're literally like just making money, all of them. Like, it's not like those cloud businesses that at some point when I die, they'll make a profit. It's not like that. These businesses are right now, you just look at them, like right now, they're making strong free cash flow. But ultimately, everything comes down to the expectation that the person is paying. So if you're paying expectation that is higher and the business model seems to be fading for whatever reason, seems to be fading, and as it comes up against the difficult comparisons with last year, investors are kind of like, okay, what kind of multiple do I want to pay for this kind of thing? So it's a very interesting period right now because since July, August, I've seen that the market has really started to split. So I've seen that where people have a very strong conviction that the business has a lot of staying power, people are paying really high multiples. These businesses that I expected to grow, people are basically just irrationally paying very high multiples. On the other side of the equation, things that people are kind of like, I'm not sure how things are going to go over the next 2 quarters, 3 quarters, or even over the next year or two. People are just like, irrespective of the underlying valuations, people are just dumping them really aggressively. Some of the companies that you follow, what have you seen?
Some of the companies that I follow don't fit into this new age, or most of the companies that I follow don't fit into this new age, new era businesses. But I've been looking at it, and although I don't actually follow Peloton, so that's a caveat. I've been looking at some of these stocks and some of those that you follow. So the companies that I'm following don't actually, there was no big surprises over there. But I think I didn't send you this, but I was watching a video the other day, a documentary, you might say, short documentary about the 99, recorded in 1999. Right at the top of the dot-com bubble, and there was a guy that now is on CNN. His name is Richard Quest. I think he's English, and he was like, "This is and he was talking to the Bears on TV.
Mm-hmm.
This time is different, and I'm going to tell you why this time is different, because we have earnings, we have growth, we have a lot of stuff. The internet is the future," and they show you a lot of bullish people in the internet, and just a few months before the bubble had popped. And it's amazing to see and I'm not saying that we're in a bubble, right? But surely there's we're not at the top, at the bottom of the cycle, and there's a lot of expectations built in these prices that you've already mentioned. And it's amazing to see the parallels, how you can relate that. Those people like paying a lot for stocks that are new, and the fact that they are new, it's great to invest in new stuff that is growing and be. Sometimes there's people that like to be first, the VC, venture capitals, and all of that. But the other side of that story is that they're not proven to be long-term investments, or they're not proven to be here or as resilient as other businesses. So it's great. I'm going to send you the link, and I can put it here on the comments section below, because it's amazing to see how people can, there are a lot of traders, how people can just extrapolate the short, relatively short period of time, and trends for a relatively short period of time, way into the future, like 60 times, 100 times cash flows or whatever, or profits.
Sales,
And it's amazing to see how this is just human psychology, right? And it's amazing to see how people can embark in this, and then these things happen, like it happened with Peloton or with other companies.
But I find it quite interesting. So yes, there is a lot of overlap with 2000s and 2021. There is so much overlap, but it's kind of different as well. So I don't really know. I'm agnostic. I don't know how things are going to unfold. What I do know is that it's the businesses are slightly stickier. So we've learned a lot already. So for example, in a lot of those kind of, let's say, advertising companies of the late 90s, we've learned the hard way that advertising is very volatile. And you look at a lot of the advertising companies, one exception being the Trade Desk, most of them, the multiples are quite low. So the market is not 100% wrong. It's quite nuanced, right? So within tech is a lot of different things right away. And within tech, some pockets seem expensive. For example, those ones where you get a customer to have a multi-year contract with you to a cloud. So you're not gonna, you take all your work that you just set up to get the IT department to put it in the cloud. You're not gonna next morning kind of say, I'm gonna strip this out because someone is giving me $1 less for my network. So you're not gonna do that. So the business is quite sticky. So yes,
but that business isn't new. That business is just real estate, digital real estate.
Enough. Yeah, absolutely. But so the customer is kind of locked in. So there is the idea, okay, yes, it is on the face of it expensive, but you have the revenue is a higher quality revenue, and that is going to stick around for a while. And you got these other businesses, like I just mentioned, the advertising business, the people kind of learned, okay, yeah, it's not really sticking around. No one's sticking around. Like with advertising, people are really much cutthroat. And that's why a lot of these advertising companies, they can't give you the guidance on more than, let's say, the next quarter. Even Alphabet itself, they don't really give you 90 days guidance, because they're like, oh my God, we have absolutely no idea how it's going to unfold. It might be okay, but it might not. So they don't give you a lot of visibility, even though they have clearly a lot of technology behind them, and they could give you a lot of visibility. But it's quite interesting. So within tech itself, yes, there is a lot of mirror image of what happened in the late 90s, but it's kind of interesting as well. But ultimately, investors are so behavioral oriented. This kind of, I've seen, for example, I read a lot about behavioral economics, and it's quite interesting to see how everyone gets so infatuated with making a lot of money in a short period of time. And someone says to me, all I want is a stock that will grow by 15% for over the next several years. That's what everybody wants. I mean, that's what we're all working for. That's the whole game. No one wants a lot more than that. I mean, people are trying their best to get that. And it's quite difficult. And the problem is as well, it's in the US particularly, things are really, really heated. But then you look towards Europe, and you get some great quality businesses, meaningfully profitable, not very expensive. So it's quite different.
Are you talking about the businesses in the same industry or in different?
Yes, absolutely. So, for example, Twilio reported about 2 or 3 weeks ago. I can't even remember, so much has happened since then. And you got Twilio that's kind of meaningfully acquisitive. So they're buying up companies, and their bottom line profitability is going in the wrong direction. So they're becoming more and more negative profitability, and people are paying very high multiple. And you got a company in Poland called LiveChat, which is practically the same. It's basically allowing you to engage with your consumer by sending them messages. So that's what Twilio does. You kind of it's an engagement platform that I can send bulk emails, highly customized to whoever they want. And you can you can look at LiveChat, and LiveChat is a Polish company, and they're growing like at, I think 20-25%, and they're priced at approximately 4 times forward sales, and they kind of like really profitable already and has strong insider ownership. But this is just one example. I mean, I can find other examples. Even in, let's say, in the US, there's this company that I own, which is the Digital Turbine, that they basically, when you install, when you open up your new phone, you get some kind of application on it. And when you open up the application, it gives you, let's say, 4 or 5 apps for companies. One of them could be, for example, Lyft. If you have Lyft on your phone, you're more likely to order a taxi through Lyft than you are through Uber. So they would pay Digital Turbine to kind of be on your phone. When you open the brand new phone, you would use and click on that on that app, and it's a custom acquisition tool. So this is something that some of the companies in the US, like I own Digital Turbine, are relatively kind of having a lot of attention. And you look at some, there's a very comparable company in, I think it's Norway, and it's priced like at like a third of the price, and it has very similar kind of growth rates. And it's just so much competition. Everyone's like obsessed with the US, and I don't know how things are going to unfold. The US has the advantage that the accounting is quite strong, but up to a certain point, it's like, I don't really know. I don't know how things are going to unfold, but it just makes me think people are paying very large valuation to participate in the US market. I don't know how things are going to go. Yeah, perhaps. Yeah, I don't know. It's quite difficult. Okay, I think we're kind of going to wrap it up here. Yeah,
just to wrap up, and I know that we're still in the middle of the earnings season. Have your so far, have your companies been posting good results, bad results, many surprises? How's it going?
So for my companies, it's this week, starting tomorrow night, Tuesday night. So I got Fubu and Upstart, which are 2 of my big companies, tomorrow night. But Twitter reported, I think it was not last week, the week before, that was not very good. I have a different company, which was Rent-A-Center, which is a brick and mortar company. I felt the results were really good, man. I was like, my God, this company is priced at 12 times free cash flow, not next year, right now, right at this moment, growing at approximately 15% right now. They have a guidance for 2023 that they're going to grow the top line by 50%. And they're priced at approximately 12 times free cash flow. And the market didn't like that they marginally reduced their guidance for the year, and the stock just plummeted like 20%. And so these are 2 of the companies that have reported for me, and so far the start of it has been really brutal. And that's the game, right? It's like there are good days in investing and there are bad days. You just have to kind of get used to it, right?
Just one note, and we've talked about dealers here on the podcast. The other day, someone talked about dealers as well. And from July 2020, so more or less a year ago, it has been a 12 bagger. So there's still some life to retail, to brick and mortar retail. So don't forget to hold it to people who are listening to us. Don't forget traditional businesses, because everyone's super excited about the new businesses and the tech businesses, and there are still pockets of mispricing in traditional businesses. So that's it.
I'll just add one more thing. So I read very quickly, I'll just say this, that I was looking at Apollo Management's, they got the blog, and they talk since like 1996 to 2020, compare high growth names with slow growth, like traditional value, where you are paying a very low valuation and the business is just kind of ticking along. And over this kind of 20-year period, the value stocks have done, even up to 2020, have done so much better than the high growth names. Although in the last 8 years, growth has been really a leading thing to be for the market, even looking back over the last 20 years as a whole, value still has done so much better. So these kind of stocks like dealers that are kind of, people are just forgotten about them, and they kind of make a substantial amount of free cash flow. They're buying back some of their stock. They're trying to figure out new ways to reinvest their profits. These are still quite very attractive, and people are paying nothing for these businesses. So yeah, definitely do be sure to check them out.
See you next week, Michael.
Thank you so much. Thanks.